Good morning, everyone, and welcome back to the Daily Hunt for Multi-Baggers. It's Friday, February 27th, 2026, and we've got a really interesting batch of insights from yesterday's market commentary.
That's right, Ethan. Our AI systems analyzed a significant volume of social media discussions and news from Thursday, February 26th. We saw a high number of posts flagging quite a few different stocks across various sectors.
Absolutely. And the sentiment is quite mixed today. We've got some powerful bullish signals emerging for a few names, pointing towards some exciting growth potential.
While that's true, Ethan, there are also some serious risk factors and valuation concerns that kept our algorithms busy, prompting caution in other areas. It's definitely a day where careful due diligence is key.
All right, let's jump right into it. First up, the streaming giant Netflix, ticker NFLX. Our systems picked up a staggering 187 hot leads for them yesterday. The community sentiment is overwhelmingly bullish, with a lot of talk about YOLO bets and excitement for a quick bounce, some even aiming for $110 very soon. They're riding it all the way down, and now they're expecting a huge rebound. Plus, we've seen positive news, like Netflix ascending while the market falls, and a pretty significant $2.8 billion breakup fee from the Warner Bros. Deal. That's a lot of cash flow coming in, Brooke. And get this, insiders have been net purchasing over 759,000 shares. That's a huge vote of confidence. This looks like a prime candidate, especially coming off a cautious buy rating just a few days ago. I think we're looking at an upgrade here.
Well, Ethan, while the market excitement is palpable and that insider buying is certainly a strong signal, let's not get ahead of ourselves with those buy tomorrow targets. The PE ratio for NFLX is still sitting at a relatively high 33.43, suggesting a lot of future growth is already priced in. And with a beta of 1.712, this stock is inherently volatile. While the $2.8 billion breakup fee is a nice cash injection and the insider activity is positive, chasing aggressive short-term gains on pure momentum still carries substantial risk. It's a buy based on the analysis, but investors need to understand the high volatility before jumping in.
Fair point, Brooke, but the fundamental shifts are strong. Given the sustained bullish sentiment, the cash infusion, and the insider confidence, my final verdict for Netflix, NFLX, is a clear buy.
Moving on, let's talk about Rocket Lab Corporation, RKLB. We saw 61 hot leads for them, largely discussing their recent financial report. The report boasted record quarterly revenue of $180 million, annual revenue of $602 million with 38% annual growth, and a backlog up 73% year over year to $1.85 billion. That sounds like good news, right, Ethan?
It does sound good, Brooke. And these are solid numbers for a company that's making big strides in space. The growing backlog and strategic acquisitions show they're expanding their footprint and building for the future. The Neutron rocket delays are a concern, sure, but once that comes online, it could be a game changer, unlocking massive growth potential.
Potential, yes, but let's look at the current reality. Despite those strong revenue numbers, the community sentiment is decidedly bearish. Users are pointing to a massive overvaluation, with a price-to-sales ratio of approximately 64.45. That's extremely high, even for a growth company. They also highlighted a larger net loss than last year, with a net profit margin of negative 0.356 and negative EPS. The high beta of 2.182 means significant volatility. And to top it off, insiders have been net selling over 7 million shares in the last 6 months. The market reaction to this good news was a drop, which speaks volumes. Last time we looked, RKLB was a stay away, and I don't see any fundamental change to warrant an upgrade.
Yeah, I hear you, Brooke. The valuation concerns are hard to ignore. For RKLB, my verdict leans cautious, but Brooke's numbers are pretty stark. This one's a stay away for now. Next up, a big tech player, Dell Technologies, ticker Dell. We only saw 10 hot leads, but the news was overwhelmingly positive. They topped Q4 EPS by 37 cents, and their guidance actually topped views. This led to a surprise in the market, especially given earlier concerns about RAM prices. The big driver? Booming AI server demand. That's a huge tailwind in a rapidly expanding market. Last we checked in November, it was a stay away, but this looks like a massive turnaround.
It's certainly impressive, Ethan. Dell's revenue growth of 10.8% and strong EPS of 7.48 are definitely positive indicators, and it's clear they're capitalizing on the AI boom. However, we cannot ignore the rather unusual negative price-to-book ratio of negative 30.919. That's extremely high, even for a growth company. They also highlighted a net selling of shares by insiders, albeit a small percentage. These are points that warrant extra caution, even with the strong earnings.
I agree it's unusual, Brooke, but the market is clearly prioritizing that AI server demand and strong earnings. The stock surged for a reason. For Dell Technologies, DEL, my final verdict is a solid buy.
All right, let's pivot to the mortgage and real estate tech space with Rocket Companies, RKT. We noted 17 hot leads, and the sentiment is very bullish.
Oh yeah, RKT is showing serious momentum. They beat EPS estimates and jumped 10% after hours. Users are calling it a monster in the making, with projections for the stock to go over $20 by Q2. We're seeing massive revenue growth, an incredible 126.5%. Plus, falling mortgage rates and improved home buying affordability are major tailwinds. But the biggest factor? Insiders have net purchased over 30 million shares, increasing their holdings by more than 200%. That's incredibly strong confidence from within. This one was a buy for us back in January, and it looks like it's reaffirming that.
Ethan, the revenue growth and insider buying are indeed compelling. I'll give you that. However, we have to look at the historical context. RKT has had negative EPS and a negative net profit margin at negative 0.03 and negative 0.0175, respectively. While they did beat estimates this quarter, we need to see if this trend towards profitability is sustainable. More critically, their debt-to-equity ratio is an alarming 251.433. That's an extremely high leverage ratio. While the macroeconomic environment for mortgages is improving, that level of debt introduces significant risk.
Understood, Brooke, but the sheer volume of insider buying and the revenue growth signal a powerful turnaround story that the market is clearly responding to. For Rocket Companies, RKT, my final verdict is a buy.
And finally, let's discuss Warner Bros. Discovery, WBD. We picked up a good amount of discussion, 73 hot leads, centered around their decision to deem Paramount's offer superior and Netflix dropping its bid. Well, you know, it's a dynamic media landscape, Brooke. While Netflix walked away, there could be long-term strategic advantages to a combined WBD Paramount entity, creating a larger content library and perhaps streamlining operations. And actually, insiders have been net purchasing some shares in the last 6 months, a small but positive sign amidst all the noise. There have even been headlines about record box office success in some areas.
Ethan, with all due respect, the market sentiment for WBD is overwhelmingly bearish, and the KPIs back it up. Users are predicting the combined entity will be a hot potato of debt and even face bankruptcy. WBD's current debt-to-equity ratio is a very high 89.857. Their revenue growth is negative at negative 0.06, and their net profit margin is a dismal 0.01281, leading to an extremely high PE ratio of over 151. This company is struggling to grow, barely profitable, and already heavily indebted. The consensus is that Netflix was smart to walk away with the breakup fee. The insider buying you mentioned is marginal compared to the fundamental issues. WBD was a stay away last month, and nothing has changed to improve its risk profile.
You make strong points, Brooke. The debt load and profitability metrics are definitely concerning, even with potential long-term synergies. For Warner Bros. Discovery, WBD, my final verdict is to stay away. All right, Brooke, let's quickly round up today's candidates. Investigate is buy, Netflix, NLFX, Dell Technologies, Inc., DELL, Rocket Companies, Inc., RKT. Investigate as cautious buy, none. Investigate as speculative gamble, Rocket Lab Corporation, RKLB.
And that wraps up another episode of the Daily Hunt for Multibaggers. Thank you for joining us today. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. We'll be back next time with more AI-generated insights to help you on your investment journey. Until then, happy hunting.